Hey guys, welcome back to the channel. Hope you're well. Today we're going to continue with our favorite topic, memory. We know that Nvidia gave us the brain, Micron gave us the memory, but right now we're focusing on that third wave of the AI supercycle, which is the storage wall. We've got two major companies right now, Western Digital and Seagate, that are in a fierce battle to see who's going to win the data lake. Many people think that the hard disk drives are a relic of the 1990s. But today, they are a major player in the AI infrastructure build out. And these two titans are in a fierce battle. So we're going to discuss everything you need to know about why the HDDs are important in today's world and which one is a better investment for us going forward. Is it Western Digital or is it Seagate Technology? So let's jump in and focus on that. But first, let's just take a look and ground ourselves on, while all of us have been focusing on the Nvidia or AMD chips that you see in the left, or the massive build out in the data centers that you see in the middle, or the huge investments that we've heard on CapEx. We've had these two companies that have been in this tug and war battle about who will win the AI data lake. And today we're going to jump in and we're going to talk about why that exactly is. But let's first ground ourselves on the performance we've seen for these two titans. So Western Digital, as you can see on the screen, over the last 2 years, have had massive returns, over 500% return. They had a 52-week high of 307. They just hit recently. I think that was an earlier, actually it was in February 12th. So it was just last week. But look at where that 52-week was. If you were early enough on this stock, I wasn't. I hope many of you were, to get in at $28 a share. What a massive return you've had. And then the other one is Seagate Technology, currently trading at $425 over the past few years, almost a 400% return on this stock. Similar thing. If you look down below, 52-week high that we just achieved recently as well. I think that was hit earlier this year at $459. Let's call it $460 a share. The low at $63 a share. Like, these companies have been tearing it up. So we're going to focus on the two main things that differentiate these companies and why they may be a good investment for you. So one is the technology they're using and how they're approaching the market. And then second is how they treat their investors overall. So those are the two differentiating pieces we'll jump in and discuss in this video. And at the end, I'm going to ask you, drop a comment. Who do you think is going to win the AI data lake? Will it be Western or will it be Seagate? But first, let's just talk about the concept of data. This picture that I'm going to put up on the screen just kind of blew me away, and I want to ground us on what we're talking about. So later I'll talk about a petabyte of data, terabytes of data, but you can just see the scale of data that we are talking about right now in the AI infrastructure build out. Yesterday's video, I talked about the zettabytes of data. You've got a yottabyte of data down below, but that is just one piece overall. And the last thing I just want to show, and just to ground ourselves, is the cost of storing 1 petabyte. You can see on your screen, we focused a lot, and we have discussed on the SSDs that SanDisk, that as well as Micron, some of our favorites on this channel, Bill. But this could help you understand why the hyperscalers are continuing to lean towards the HDDs instead of going all in on the SSDs for their build outs. Just look at the cost of storing 1 petabyte, whether you focus on SSDs on the right, where it's an average of 1.5 to 2 million from a storage perspective, or if you look at using HDDs on the right, significantly more affordable option for the hyperscalers when you look at the costs ranging between $100,000 to $500,000 for storing 1 petabyte. So let's debunk the myth, first of all, that HDDs are relics of the 90s, that they're not needed. I think you just saw right there from a cost perspective why they're continuing to be needed from the hyperscalers. We know we are in this supply crunch for memory overall. And our hyperscalers are projected to spend over $700 billion this year alone in CapEx spending. So this will generate an exabyte explosion overall for us. And it's critically important because if we think of the AI infrastructure like a library, GPUs are the reading room. They're fast, expensive, and they're loud. But 80% of the data in a hyperscale environment, the stuff that AWS, Microsoft, Google use, they don't live on expensive chips. That data lives on hard drives. And Western Digital's CEO recently dropped a bombshell. He mentioned that they've shipped 215 exabytes of storage in a single quarter. And I mentioned this yesterday, but just to put it again in perspective, their revenue is expected to double this year. They're crossing the $12 billion mark. And they already have supply contracts locked in with the big 7 cloud providers for the rest of 2026. So this isn't just a hardware story anymore. These HDDs are part of an infrastructure monopoly. Think about this. Every time a model like a GPT-6 or Gemini, the most recent version, is trained, it creates massive checkpoints. A snapshot of the brain at that moment. You can't delete them, but you need to access it. You need to access them in milliseconds. Storing this on SSDs, such as what SanDisk has, would bankrupt even a company like Google. As I showed on that screen earlier, hard drives are still 7 times cheaper per terabyte than flash. In 2026, HDDs are no longer customer tech. They're critical infrastructure for this build out. This is why 90% of Western Digital's revenues today come from the cloud. They aren't selling to you anymore. They're selling to the kings of the internet. But there is a difference on how they approach the market. And it's particularly focused on today, Seagate uses a HAMR approach. So that's heat-assisted magnetic recording. And we see that Western is still continuing to use the shingled magnetic recording, or the ultra SMR, as they say. They are trying to work towards HAMR, but currently right now Seagate owns that technology. So this is where it gets a bit spicy for us as investors, because Western and Seagate, they've taken totally different approaches, but they both are in a hot pursuit for the holy grail of HDDs right now, which is the 100 terabytes on a single disk. So Seagate's strategy is very clear and simple. They use lasers, which are aligned with their heat-assisted magnetic recordings, or HAMR, we like to call them. They're the first movers in this space. Their Mosaic 3 Plus platform uses the HAMR approach, and they literally use tiny lasers to heat the disk to 400 degrees Celsius for a nanosecond so they can write data more densely. The pro to this approach is Seagate overall, is they're already shipping 30 terabyte plus drives in volume, and they've qualified with big hyperscalers like Google and Microsoft. The cons is that lasers are hard. Manufacturing these drives is complex and it's expensive, and it helps explain why Seagate's gross margins are currently sitting around 32%. Now, if we take a look at Western Digital, they're a different strategy. As I mentioned, it's more of a brute force ultra SMR strategy. It's a safer route from a lot of analysts' perspective. Instead of using lasers, they are using the ultra shingled magnetic recording, or the ultra SMR, which is essentially overlapping data on tracks like shingles on a roof. The pro to this move is it's cheaper. Western Digital's latest 40 terabyte ultra SMR drives use 11 platter design that is incredibly reliable. The con is that they are behind the laser. They're behind the laser roadmap, and Western Digital won't ramp up their own HAMR drives until 2027. Despite being behind on the lasers, Western Digital is currently winning the profit war between these two companies. In 2026, the second quarter of this year, they reported a recorded 40% gross margin. So they're proving that potentially you don't have to have the fastest tech in the AI infrastructure build out. You just have to have the most efficient factories. And the other piece that's differentiating these companies from an investor perspective is just how they approach us overall. What is their strategy overall? If you take a look at since 2025, Western is a pure play high disk drive company now, just like Seagate, but they treat the shareholders very different. Western's approach is more around, and they just did it on February 3rd. They authorized a $4 billion share back program. Their goal is to try to squeeze their share price higher by reducing supply of share in the marketplace. And they only pay a tiny dividend, about 0.18%, because they're reinvesting every cent they make to try to capture and try to win that road to the 100 terabyte drive Seagate, on the other hand, is a dividend darling for investors. They maintain a 74 or 75 cent quarterly dividend throughout their entire cycle. And their goal is stability. And if you want, I think the most recent I saw dividend yield from Seagate was about 7%, 6.8, 6.9%. So if you want a company that provides dividends while you wait for the super cycle to mature, Seagate Technology is the play here. The red flag, though, is Seagate is carrying about $5 billion in debt. And in today's high interest environment, that is a heavy backpack for the organization to carry. Western Digital is a much leaner organization. And this is why analysts currently have a strong buy on Western over Seagate, despite Western's stock being near all-time highs already. So the question is it too late to get in to either of these stocks? Is everything already baked in or priced in to the stocks? We just have to remember that stock prices typically reflect what the market knows today about the next 6 to 12 months. What they cannot foresee or perfectly price in is the unforeseen long tail growth that we expect in AI. So if everyone expects AI to grow at a 20%, that 20% is baked into the stock for both of these organizations. However, if AI actually grows at a 40% rate, the stock still has a massive upside and a lot of room for a bull run. The reality, though, for Western and Seagate is the market is betting on a recovery in storage demand. If the mass capacity cycle that we see today, which is driven by the AI data centers, if it lasts longer or peaks higher than analysts currently predict, this current stock price we see for both Western and Seagate may actually be a bargain. Now, there's two other factors that we need to consider, and I would just put them out there in full transparency. You have the insider signal. So just a few weeks, 2 weeks ago, I think Western CEO sold about 5 million in stock, and Seagate CEO did something very comparable, offloading about almost 9 million in stock. Now, these are often seen as preset moves or plans for the company and the CEO, but it tells us one thing that I think it could tell us one thing, that is the easy money already made, or were these CEOs looking to just do some profit taking, given the historic run these two companies have been on. Also, the other thing to consider with both of these companies in the HDD space, that if there is ever any over ordering from our hyperscalers, particularly like Microsoft and Amazon, if they bought too many drives in 2025, they'll potentially could slow or stop ordering to digest what they have in their inventory. And every time this has happened in the past, if we look at 2015, 2018, 2022, these stocks have stepped back significantly. So 3 things we need to watch for as investors, and things I will continue to keep you updated on in this channel, is we have to keep our eye on the exabyte shipments. If it starts to slow below 20%, we may need to shift strategy on these companies. Also, gross margins. If Western Digital's margins dip below 40%, we have to question whether the pricing power that they have has evaporated with the hyperscalers. And then finally, and most importantly, I think, is the SSD gap. If NAND flash prices start to pull back or start to crash, and it makes the SSD's inventory suddenly affordable for hyperscalers in a bulk storage strategy perspective, the HDD party will be over. SSD is a better technology. It's faster. It's just too expensive for the hyperscaler. So if it pulls back and it makes it more affordable, I think the HDDs will be at risk overall. So which one do you think will win? Who are you going to pick, Western or Seagate? In my opinion, if you want the technology leader, you go with Seagate. They own the laser patents. They defined the 100 terabit era. But if you want the profit leader, you go with Western. Their 46% margins and the $4 billion buyback program make them an absolutely beast in this category for 2026. They're proving that the AI era and the warehouse manager is just as important as the architect in the space. And I want to circle back to the priced in debate or argument that we often get. The current price, as you know, reflects the average expectation. So if we believe that the AI-driven demand for data storage will be more aggressive or more permanent than the average investor thinks, then it isn't too late for these stocks. Personally, I'm watching the $300 level for Western. And if they can break through that 300 level, we could see $375 a share by year end for Western Digital. But I want to hear from you. Who are you betting on? Are you betting on lasers or platters in the storage war? Do you think Western or Seagate is more upside potential? Drop your comment below. Let me know your thoughts. As always, I appreciate you guys watching the video. Please like and subscribe, and I'll see you in the next one. Take care.